for coming back. I hope you enjoyed your lunch. I hope you had amazing discussions, made new connections, and were able to talk to some of our founders or your fellow investors. For sure, Arjun, and thank you very much for making this trip. You came and flew in extra from San Francisco for this, so thank you so much. And we share one joint kind of experience, which is Kaufman Fellows.
That's right.
That is for sure one of my memorable journeys within venture, and something we've done there, and you know this from the network, is more like a peer learning experience, and for sure it is only great if we can aspire to be sometimes like Tribe Capital is. You're slightly bigger than in terms of AUM. So Arjun, and looking at your career, I don't know kind of where to start, because you have done so many things over the past. At the moment, you are CEO and co-founder of Tribe Capital, and you have around 1.7 billion under management, specialized on venture as a platform. And notable investments, let's say in Web3, is Kraken, for example, where you are on the board as well as Consensus, as well as Binance US, and also some traditional great companies like Kata, like Bolt, like Airtable. And before Tribe, you were a partner at Social Capital, where you invested in companies like Slack or Swarm, which you sold to SpaceX. And amongst other things, you are, I think, noted top 100 angels in Silicon Valley, with investments like Lyft, Snapchat, and Open Door. I could go on and on this list. So great to have you here. As well, you have
that whole. I feel very old now that you mentioned that full list.
Yeah,
I guess the white hair makes up for it.
I don't see it yet.
It's there a little bit.
But to add to that, you had a complete different past before that. You were a serial entrepreneur. Mm-hmm. You have successfully sold at least 2 companies, I think. But can you tell us a little bit about your founder journey?
Yeah, I think what I usually like to start with is that the path that I took was a little bit different, in that my whole goal was to find the best people that I can work with. And the best way to facilitate that and learn from those people was to create companies. So most of the companies that I created were around the people and the products and projects that we could build together, rather than, hey, I've got this like extreme vision. That was the beginning. Over time, it changed into trying to figure out, well, I've got this idea and this concept, and then how can I put people behind it? If you look at the full journey of all of these companies and these projects that I've been a part of, I think the central thesis behind any of these initiatives has always been the data and the architecture underlying the investments and the companies, and what that allows us to do, and myself personally, to be able to iterate as quickly as possible and build experiential projects. So most of everything on that, outside of 1 or 2 initiatives, has been truly around how do you think first principles from the ground up, leveraging the data that exists within the company itself. So you could either build a company, you can invest in a company, you can invest in the asset class, but that's kind of the way in which I always like to talk about the trajectory of my career. So it's very easy to say, hey, you had 12 companies, 2 of them worked. One was sold to a Korean and Japanese gaming giant. The other one was to Yahoo. And then at Yahoo, I went as an executive and also sat on the board of Alibaba. But outside of like, hey, we did all these cool things, it was more that the trajectory of getting data and understanding it, interpreting and ingesting it cheaper, better, faster over the last 20 years is probably a better way to sort of, what I like to encapsulate on how I've liked to spend my time and my journey, and what I continue to work on today.
Is there like something from your founder journey which you have taken on to Tribe? Like, how do you implement these experiences within Tribe now, being investing on the other side of the coin?
Yeah, I mean, Tribe is a manifestation of all of those years. So today, we're roughly about 2 billion in AUM. Half of it is our commingled funds, and then the other half is our what I'd like to call is on behalf of our clients, so people that we partner with. And so we partner with our LPs in so many significant ways. It's not just a commingled funds. It's not just, hey, take a look at these companies. It's more about like what are they looking to do, from a corporation to an insurance company to a Ministry of Finance to a state sovereign fund. They all have different initiatives around what they care about beyond just financial returns. And so my whole goal was, again, I use the word build and buy a lot, which is, when you are a venture capitalist, you're buying an ownership stake, a minority stake, that is going to grow at high velocity. And why we like to build as well is that what are all of the mechanisms we can build in order to make better investment decisions or in order to make new decisions. So the way Tribe is set up today, I'm actually not the CEO anymore as of 2 days ago. He's sitting, Boris is here, right there. So just stand up real quick. The whole goal of Tribe was we like to test and iterate a lot of things, and I think we met in Kaufman I think a while ago, but when we started 5 years ago, we had 0 AUM, and the whole goal was that what are all the ways in which we can have a unique point of view in the world, and so we like to use words like unlocking truths, unlocking secrets, and well, how do you do that? And our interpretation of that is that there's raw data that exists within every company, especially if it's software and tech enabled. And that was our superpower for so long, that we should be able to build our products and services to be able to just unlock what's unique about any company. So the whole formulation of Tribe was that the largest portion of it today is that we have our asset management business, but we also own equity in other businesses now over time that we've built or we've partnered with in some ways. So one of them is Termina, which is our quantitative tool that we use and what made us so unique in the first place. That's a separate company now. And then another one is a Latin American fintech bank that we helped incubate and get to a certain phase, but we kind of came in as co-founders there as well. So there's kind of 3 arcs to how Tribe looks like today. And the goal has been that we should be able to unlock as many unique insights and opportunity sets for us to partner with anybody through that view. And that lens has always been data. And I think a lot of people just throw the word data out as we're data driven. You can probably see it in everyone's pitch decks. But our whole goal was like, can we build our R&D team and our products team to be very surgically focused on leveraging those insights and actually making decisions based off of that.
Yeah, this data-driven approach, I think that is what Tribe is known for, and at least in the VC community. But what I wonder is, does it really work at pre-seed? Like we, for example, are focused on pre-seed and seed, the very early stages. Sometimes you only have a team in a pitch deck. How do you think about that versus investing in mission-driven founders? Does it, or from what point does this data-driven point and data-driven approach work?
Yeah, so typically when we come in, we're coming in at the Series A, B, and C. And Series A, B, and C is different across the world. So in the United States, the C round is typically mid-stage and late-stage. But in India, for instance, B and C is a little bit more early, right? So I think the right way to think about it is we come in at enterprise value around 50, and the top end is maybe around 250. So everything within that range is our entry point. I think you could be data-driven and mission-driven. It's just that most folks, when they start firms and they focus on, I'm sure you've heard this term, they say your fund size is your fund strategy. So they'll say if you have a $100 million fund, then you should only be focused on early stage. I kind of take issue with that because what it really means is that you aren't a good picker. And what I mean by that is if you're an asset allocator, I'm an LP in many funds too. And so what you see is that everyone talks about the 1 to 2 companies that drive their funds, and everyone's solely focused on that. And so what that really means is that your loss ratio is going to be high. And the reason why your loss ratio is high is because you're bad at picking. And pre-seed and seed, the reason why you're bad at picking is that there is no data, right? Like you're focused on people, right? So people and processes, and you have a thesis around how you want to partner with those folks. That's fine. Having a high loss ratio but high multiple returns for a pre-seed and seed investment is fine, because there's nothing for you to be able to attribute towards what I would call forecasting. A lot of people will say that there's a special sauce in the founders or have a thesis in the ecosystem. I think those are all fine, but if you look at just broad range returns for everyone who's at the pre-seed and seed stage, that always becomes an issue. Now, the other piece to that, which I'm sure we'll talk about for Web3, is that the duration for liquidity is shorter. And so the multiples might be better, or a lot of the risk ends up being bifurcated across mid and late stage rather than purely at the early stage. And so there's a reward for being early. But that's not the case for traditional venture, where if you're a pre-seed and seed investor, you might be waiting 10 years until there's a liquidity event. Things are changing in the secondary markets today where that might become easier, but the first angel investment I ever made was in 2005. And that company today, I still have no liquidity, and I'm just waiting, right? It's going to be 15, 20 years most likely. It's a great company, but I'm still waiting. And a lot of LPs are still waiting for those types of return profiles as well. So our whole goal when we started our mission was that could we invest at the moment that we could detect early versions of product market fit. So we say quantifying product market fit. And then through our expertise, could we build and amplify their product market fit, given how we've done this for multiple companies like Square, Uber, Airbnb, et cetera, where we just built that from scratch on their behalf. And so we felt that the earlier we can do that, the better in terms of multiple and returns, and can we find that? So to answer your question, that was a long version, but the short answer is yes. The moment we detect product market fit is when we invest. But the founders are still early in their career, right? They've never, on average, they've never scaled companies before. They've never hired business people, ops people, a CFO. Our whole goal there is to help with that side of the governance.
Yeah, I get that point. I mean, concentration in VC is probably the way to create alpha, and especially if you have more data available, that alpha is not so unique anymore. So that's, I would say, is a broad difference between late stage or early late investing and the very, very early investing in pre-seed and seed. And if you manage through data to get a more concentrated portfolio and more information than your peers, then you're able to create outsized returns on that portfolio, whereas your peers probably can't. And that's for, I think, for early stage, that is the most difficult part, is where it's more conviction-driven investment. It's more mission-driven investment, or where you have seen a certain business case work before. Is there, where are the points in your career where you have relied more on your experience than on the data, or where you, I mean, as an angel, you invest pre-seed, right? So you couldn't apply your data model. How do you do it there?
Well, I always like to tell a story that all of my conviction bets are my worst bets. It's like that's why we started the firm this way, because every time I met a founder, they're like, when you're a founder and you're building something, you just are irrationally passionate about building, and so there's a reason why they're mission driven, and so that's intoxicating, right? When the founder comes in and they speak about their company, you want to work for them, you want to work with them. That's the whole point. So that basically means that I just give them all my money. That's why I'm so illiquid today. I think I'm gonna go back to pre-seed and seed. When you take a look at when you make investments, you have a certain amount of investments that are new investments, and then there's a certain amount of investments that you have for reserve or follow-on. I don't believe that you need that same mission and conviction of the people when you're doing the follow-on investments, because by then you're able to see a lot of asymmetric information around how the company is performing. So the way in which you should think about what we do at Tribe is that we're all about understanding and the underlying product market fit for the company and where they are at that stage. And my job is to not care about who the person is or where they're from, what their educational background was, nothing. My job is to be a chameleon and wrap ourselves around what they are and who they are and figure out what their extreme product market fit is, and then continue to help them with that raw foundation. That's kind of how we think about it. And I don't think that's any different than having conviction at the earliest stage, because the earliest stage, you're shooting darts in the beginning. But then after that, you're becoming more and more refined around how you surgically throw the dart. And I think that's the difference between what I believe are good investors at the early stage of pre-seed and seed, and at the later stage. And I think that's where, frankly, a lot of people mess up because they take that same conviction orientation to the later stages, right? Because they'll say, Sequoia's coming into the round, like, I got conviction. Well, if they weren't in the round, would you still have conviction? And the answer should be yes if it's a good company.
Yeah, I agree. So you shouldn't base your investment decisions on whoever is in the round. A question VCs always love is about the anti-portfolio. So the deals you missed, even through like a data program or maybe not seeing them. I think you mentioned in a discussion you passed on Instagram and Airbnb.
Yeah.
How was your thinking, or would you have done something differently today, knowing what you know now?
Yeah. So when so there's a place in San Francisco. It's called Dog Patch Labs. It used to exist, and when I had started my first company that merged into Lolapps, there was a company called Bourbon, which was started by the Instagram founders. They were like basically a seat across me, and then the Airbnb founders were like diagonal. And at the time, this is kind of like the arrogant founder problem. At the time, I had about 150 million monthly active uniques on the Facebook platform. So I had a lot of data. I was just growing at a pretty high velocity. So I was thought of as like the cool kid. By the way, on the other side was Jack Dorsey starting Square with this really ugly Square tablet. And it was really big. And he was like, this is going to change the future of tablets. Anyways, when they first came to me and they were like, Arjun, you're amazing. You have 150 million users. Take a look at my really small product. And I looked, and the first thing I thought was like, you guys are small. You guys don't know anything. You're sitting in here, and I'm like the biggest bad guy that's here. And I think this is the problem with the whole conviction bets is that everyone around me, all the other investors said they're stupid too, right? Including my own investors. And I looked at the other VCs and I said, okay, yeah, like they know what they're doing. And so I passed on all of them. Airbnb I came into later because like we stayed close. But the whole point was that they were growing at a high velocity. Everything that they were doing was extremely measurable. Before it was Instagram, it was a company called Bourbon. And they took that specific feature and they made that their product. But the whole point was that all of that was extremely quantifiable. You could have done the exact work that I do today to recognize that it was working. And so my whole point was that I didn't want to rely on my feelings, or I didn't want to rely on the network telling me it was a good or bad company. Because, those are 250, 300x multiples that I could have gained as an angel investor at the time. Obviously, things have changed, but I mean, my anti-portfolio is large, even at Social Capital. And again, it's the reason why we started the firm was that I didn't want to have great inbound deal flow and then be bad at picking. I wanted to make sure that my inbound deal flow continued to exist in compound and that I could identify companies through a quantitative framework where I would miss the least amount as possible. But the last story I think would be funny is there's a company called AngelList, if you guys are familiar with it. Before AngelList became a product, it was a literal list, and they would send it to all these angel investors. So I got this spam email saying there's this much allocation at Uber at like 6 million in enterprise value. And I looked at who it was from, and it was from Naval. And at that time, he was just trying to figure out how to like get people to invest into these companies. But I passed on that too. And again, the reason why I passed on it was because it came through this spammy email that also went to my spam, instead of like responding to it and saying, can I just take a look under the hood and look at the data? And so today, everything at Tribe is like, it doesn't matter where the source is from. We just take a look and do the underwriting data. And that's actually what's driven most of our returns. If you take a look at our most profitable multiples in our companies that we've gone into, they came from some of the worst sources that you could think of, but they're good companies, and that's what we care about.
Yeah, that for sure is very interesting. But the founder who takes that decision to move from Bourbon to Instagram, it's basically the capabilities and qualities of that founder, right?
Absolutely. Yeah. But I would argue that those are measurable because you can see what they did at what time, how to quantify it, what were the specific consumer engagement metrics that started to work when they built it, their GitHub repository, and all the actions around how the team is integrating from architecture to product iteration is there. You can take a look at it. And I think that's really important, is that in order for you to be able to do the qualitative work, you want to make sure that you can get the context of the foundation that they've already built. And I think there's the veneer, and I would look at that as a qualitative aspect, which is how good is that on top of a foundation?
Now, an event everyone still has in mind is now it's moving a little bit to the crypto market, Web3 market, is FTX and the platform blowing up, and Sam Bankman-Fried kind of being the reason for this. And you've been invested in FTX from the very start. And I think this now understanding how difficult picking is, and that you only have the information at hand once you take that investment decision. I believe that this could have happened to anyone, and everyone probably would have loved to be part of FTX and has invested, including us, at that point in time, right? But of course now everyone says, okay, why didn't these people know it, right? Where were the red flags? So maybe can you take us through that decision process, deciding to invest for FTX, and what happened on the way? And you met with Sam regularly, right?
That's right. So I'll take a step back, and one of our LPs is Ken Griffin from Citadel, and he always reminds me of this story. And he had given a call with FTX when it first happened, and he said, "Hey Arjun, when the Enron scandal happened in the United States, everyone retreated. They got really scared of those markets. And the first thing that I did with my team was that I flew there with my folks, and I basically said, okay, who are the best people, all the R&D, data scientists, engineers that worked on the core function that was working, and who are those people? And I want to meet every single one of them." And basically over the course of a couple months, he went to ground zero, like right there at the floor of everything that was happening. And he met with every single person. I think it was a couple hundred people. He had hired basically about 30 people, and he said, hey, those 30 people today have given me $40 billion in profits, which is I took the best of what worked. So when there was a fire, I ran right into it, and I've got the best people, and then I created a whole new business line out of it. And the reason I say that was that Enron worked, and the parts that didn't work was their financial engineering and their fraud, right? And so I would separate two things, which is the business from the people. And so when we look at any opportunity, the first thing we take a look at is the business working. So here are the numbers, not at the peak, but at the down trot of FTX, which was they had about $1.2 billion in revenue and about 600 million in EBIT. Those are raw, hard facts, raw, hard numbers that you could quantify. And what Sam decided to do, similar to what you see in other folks, is dip into customer deposits, which is just pure fraud. So I'm glad the whole process went through and he got convicted, but what he decided to engage in was pure fraud. And I think the hard part for those are that's always going to be the case. You're going to see that in other companies, and the question ends up being is what's the scale at which the fraud happens versus what isn't there. The business continued to work, but he dipped into funds. And one of the reasons why you've seen us continue to engage with even like an FTX reboot or supporting that reboot from other partners that are out there is that company, that product that served their customers was extremely needed in the ecosystem, extremely valuable. And if they don't do it, some other folks are going to do it as well. And so it's why you've seen other exchanges like Coinbase and Kraken start getting into futures and derivatives and options as well, to try to figure that out, because the market needs that and needs that liquidity for the crypto assets to be able to survive and thrive, in our opinion.
Yeah, and if you're building a company in this innovation space, most of the time there is no regulation yet, right?
That's right.
And so you are on the board of Kraken as well. How do they do it differently to FTX in terms of governance, for example, or mentality? Is there a difference in founder type you would identify?
Again, I would separate the people. So the Kraken story is actually really interesting. They were birthed out of Mt. Gox. So if anyone's been around a long time for crypto, Mt. Gox was the first one that had issues with accounting, had issues with their asset liabilities mismanaged. There was just a bunch of things that went wrong there. So I won't go into the specifics, but the whole point was that Jesse, who's the founder of Kraken, went specifically there on behalf on the trust on behalf of a committee to just literally go line by line to help them with their ledger. He went through and he was like, I'm just going to build my own exchange after this, and which is essentially what he did. I think what's interesting with him is from day one. Actually, I'll take a step back. When I came onto the board of Kraken, they basically said, hey, we would really like help with governance and an independent and thinking around how to build ourselves to go public one day. And that might be in 3 years, 5 years, or 10 years. But we have multiple businesses, multiple units, and we're not just a one product company. And so I came on the board after we invested. And I think we're pretty heavily invested. I think to give you a scale of number, I think we were roughly about $150 million deployed into Kraken, so we're pretty concentrated. And the amount that we had deployed into FTX was like $20 million. So there's a vast difference of like how we did it. We do care about investing into the ecosystem. Same with Binance, it's a very de minimis number. But our whole goal was to just try to understand how the full ecosystem can work with each other, similar to how we thought about LinkedIn, Facebook as a larger part of the market. They're both in social networking, but touching different customer segments. And I think with Kraken, they basically thought about independence and governance day one. They thought of it themselves. And I think what a lot of people forget is like in some of these new categories, especially in crypto and blockchain and that settlement ecosystem, there was no auditors. None of the big fives were auditing crypto. And so a lot of people go back, history always gets sort of rewritten. Today, yesterday I met with an LP on the phone and he was like, you guys should have had auditors for crypto. And I said, there were no auditors for crypto. Like literally, no one was willing to audit crypto companies. And that didn't start till, I think, about 2020, roughly, when they started doing it. I think Mazars was the first one. And they were the first ones that engaged with us on Kraken. So I think a part of it is just, what does the team do in the meantime in order to verify those transactions? How could you verify that on the block? What are all the ways in which you can be transparent? And I think Kraken did a good job of just being transparent to all their shareholders, no matter how big or large they were. I'm not necessarily sure that comes from just the top. It's just that there was a collection of individuals that believed they needed to do that from day one.
Yeah, but I also think it's a philosophy, right? If there's no regulation, but you still want to build the best product and be compliant, then Kraken is a perfect example. I mean, this came at a time where there were one black swan event after the other, right? We had Corona, we had Ukraine, now we had the Israel crisis, and
you also have the ongoing banking crisis in the United States.
Yeah, for sure, with Silicon Valley Bank.
That's right.
That changed a lot for the ecosystem. How do you think that will change the VC industry going forward, and will the model change of VC, or how do you react to these kind of topics?
I mean, the way we're built is we're long duration investors, so we are not thinking about like speculation quarter by quarter. And I think a lot of people like to live in that world of speculation, as you can tell, right? Like headline news, etc. So I think there's two things. One is that we've been on this historical trend over the last 50 years where the rates have continued to go down. And the reason why the rates have continued to go down is that it was rates with liquidity. I think this is sort of a good way to put it. And the more access to capital that you have, the more that you're able to invest in traditional assets as well as alternative assets. So I think that's why you've been able to see that in the private markets in at least Western markets and Western countries. On the flip side, in a lot of the emerging markets, you have high interest rates and you do have a certain amount of high inflation, but they're growing at rapid rates, right? I think India is going to clock in at around 8.5% to 9% economic growth, and I think they're going to continue on that path for a while. We'll see where it slows down. There's a fundamental difference between how you think about those types of markets and obviously specifically what happened in the United States. And so I think the private market assets will continue to evolve, but there's a difference between early, mid, and late stage in private. And so when someone says VCs, they will use the word Kleiner Perkins and SoftBank in the same sentence, and those are just two very diametrically opposed organizations of where they invest and how they inflect. So I think when I think about venture capital, I think about inherently buying low and selling high, which is that my multiples ideally should be in the 5, 10, 20x from my entry point, not 1 to 1.5x. And 1 to 1.5x is just a very different asset class, and that's the way to sort of think about it. And I think that's what's really going to change is like at what stage of the venture game or the private equity game are you really playing? What type of firm are you? And are you indexing the market and focusing on market beta or alpha. And again, we play and we focus on the alpha stages, but I think that's like a healthy way to think about it. And given where we are, I just think that the overall slope of private investments and the rates and liquidity environment, when you take the volatility out of what you've seen over the last 5 years, we've been on a steady track of the asset class continuing to grow. I don't think that changes.
Yeah, if we talk about the hype cycle, or crypto had a huge hype, even though if it's a technology appreciation. But the same way, also venture has come down, crypto has come down, and it was the feeling that there was just one funding round to the next funding round, higher valuations, and the one who was holding the torch at the end was kind of the stupid one in the room. Mm-hmm. At least that was the feeling, right? So what is the difference between the crypto market and the venture market there? And what is the true learning for you, and which you maybe also transport to Tribe, or for us generally in the VC market, investing in the space? What should be different? What is the learning out of the past kind of venture hype and crypto cycle?
Yeah, I would separate valuations from good companies. So there are good companies that raise at high valuations, and there's bad companies that raise at high valuations. So those are two separate things. And I always think about this word dollar cost averaging. So in some of our best companies, they raised at, so I'll give you an example. We have a company called Docker. In the last round they raised was at 2 billion. Well, I can now pick up secondaries at 1 because there's shareholders that are early that just don't have asymmetric information or don't understand the speed at which the company is compounding. So I'll buy at that. We have a company in India because India got hit hard because they read this newspaper article about all of these companies in India not doing well in the public markets. Okay, well, if you quantify it, they did really well if you were an investor at the Series A, B, C, and D, but maybe not if you were at the E and the F. And so what happens is that all these people retreat. And so if a company's worth $1 billion, you can now pick it up at 300. But if the company goes public at 4, you've made this massive alpha spread. And so there's a lot of opportunities, assuming a company is good and it's continuing to compound. And I don't think that's any different in crypto, right? If you just take a look at how it grew and what the accrual of value looked like, then there's going to be an equilibrium. And so you want a dollar cost to average into the assets that are really good. Now, it's very easy to say that, right? Because everyone says that, which is, the prices are better for these companies. But you have to make sure you're getting into companies that are actually doing well and that are ones that are actually compounding. And a lot of people, again, don't do that work. They'll just keep putting money behind bad companies. So that's how we think about it internally. That's how we've been spending our time. Again, we're a long duration. So when we're coming into a company, I'm thinking 5-7 years out, what are they worth? I'm not thinking 3 quarters out.
I mean, I could go on with the questioning forever, but maybe someone from the audience has a question. Yeah, Dave. What?
Hi there. So I was just wondering if you can speak more about the product market fit, because I get to speak with a few, and I appreciate that a lot of people are looking at pre-seed, seed stage, data-driven approaches, and they're more focused on people. But the product market fit, where I struggle with, is that I think you need benchmark per sector.
That's right. Yep.
So how do you go about creating these benchmarks?
Yeah, so I'll see how technical I can get. So you're absolutely correct. The right word is benchmarking, because then you can get comparative sets. So when you take a look at raw financials of most companies, you're able to take a look at a widget company against a grocery company and a software company. And you say, okay, which one do I want to put my money against? Which ones are compounding? Which one has linear or super linear rates of growth, right? So you'll take a look at Costco, or you'll take a look at Netflix. They're like similar types of business models, but different assets that they have underlying towards their customer base. When you take a look at software, all software is built almost the same. They use the same architecture, the code in the same way, the way in which consumers engage in the software itself is the same, right? So you click on something, you use it, there's a raw transactional log. So the way the framework that we built 20 years ago, that we continue to build on top of, is similar to how you think about GAAP accounting and financials. You can do GAAP accounting for software, which is how do I quantify a model of health for how people engage and consume software. So if you can bring those two things together, that can be an extremely valuable data set. Easy to say, hard to do. But the way to do it is that we've met with now thousands of companies worldwide. And so when I meet with every company, I ingest all their raw data, all their raw financials, I tag it, and incept all of those pieces. When you do those qualifyings and you store all that data, then I can start benchmarking every heuristic around how software is engaged. That's what we've done for the last 10 years.
Any other question in the room? Otherwise, I would maybe close with this question. What are in venture, or specifically Web3, as we're kind of in a Web3 setting here, are the topics you are most excited about?
Yeah, I mean, so I don't like the words AI, machine learning, recommendation engines, Web3, data 2.0. The reason why I don't like it because it encapsulates a headline around FOMO into a very specific category. And the reality is that software is like the underlying substrate around all of this is what we're talking about. So like, what is it for blockchain and crypto or Web3 is more, what are all of the fact that you can have programmable money embedded into a use case is the key thing that's really important here. And so when you think about, all of the markets that have embedded capital or finance or settlement or mortgages or insurance or tokens, whatever you want to call it, is like, what's the use case that you can use in order to be able to have something grow at high velocity or have something be disruptive or revolutionary for that market? And so when I think about anything that's happening in crypto or Web3 related products, is that we are just extremely excited about all of those components being able to sort of have companies in certain countries leapfrog the domestic markets that we're used to in Western markets. So I'll give you an example. We have a company in Latin America, so they just bought a bank, but all of their settlement that they move money from Colombian farmers to moving inventory to someone in Mexico, a distributor, warehouser, to sort of shipping it to the United States, that whole settlement layer today costs them basis points because they use stable coins. Awesome, right? They're a financially regulated company. Then you go to the next one, which is, okay, now how do you think about remittances? Then you go to the next one, how do you think about mortgage-backed securities? You go to the next one, you say, okay, how do you think about insurance? So a lot of these is that we're figuring out how to now think about the back-end layer. And then what I'm most excited about is in 10 years, how do we start marrying the front-end layer of consumer experiences with the back-end layer now that's not 50 years old? And what does that actually mean for a lot of these markets? So I'm generally pretty excited about anything that's in like financial services and fintech related to blockchain and crypto.
So in essence, is the company worth building and solving a real problem?
That's right.
Rather than being stamped with Web3 and everything. Probably, I don't know if you know it, but the next panel talking about Urbit is somewhat going into that direction. So thank you very much. Please, everyone, give me a hand. Arjun, thanks a lot for being here.